Hello everyone. In my today's video, I'm going to discuss about V2 retail, especially the recent con call summary for Q3 FY26. So we'll get into the details and we'll obviously take the most important point in the juice of the con call so we understand how was the Q3 and what is the management saying about the future. Okay, so let's look at the revenue. So the revenue increased by almost 57% to 929 crores, and the PAT was up by almost 99% to 102 crores. EBITDA margin stood at 18.7%. And in the last 9 months, they have added almost 105 stores, which has taken their total store count to 294 stores. And they recorded a record volume growth of around 48%. And out of this and one of the other important statistics that they shared is that 92% of the product that they sold was on full price. The most interesting thing about the business model of V2 retail is like almost close to 91 to 92% of the products which they sell in their stores are on the MRP, not on discounts, which obviously gives them a better margin and better profitability. ROE has improved to 24.5%. And the other thing that management confirmed that in the Q3 quarter, the average billing value increased a lot. So what was the reason? The reason is because this is a winter season and they sell a lot of winter garments on which the average selling price are more, and obviously the margins are also quite high. So when we understand this business model, we need to understand that it has seasonality, right? Generally Q2 being the weakest and Q3 being the strongest. Okay, and that is the reason why they clearly told that the average billing will always show higher on Q3 because they sell all these winter garments like jackets, sweaters, and everything. And the other thing, management said that they're very confident at growing at a very high pace. So the way the business run, the way they operate everything, they are not worried about that the pace of sales will slow down, but they are like saying that they can grow at a faster pace, which is quite good. And they said that they are in expanding their reach because they're not just going into tier two and tier three cities because they're entering into rural markets also, and they're so confident that their products would be loved and would be sold. And for the growth, the company see any companies who wants to grow requires money, right? So in order to fuel this growth, what the company did, they successfully raised around 400 crores through QIP, through market investors, and which they are going to use it for their future growth. And the plan that the management has is that currently they have 294 stores. In this quarter four, they're going to add around close to around 30 to 35 stores. And in the next year, they're going to add almost 150. So imagine currently they have 294, and the next year they're already planning to add almost another 150 stores. So they are so confident, and it's almost like on an average, the growth of stores will increase by more than 40%. So there were quite a few questions related to working capital because the people asked that why there's a decrease in payable and due to which there's an increase in working capital this time. That's where the management clarified that the money that they receive out of that in advance only, they have paid 300 crores to their vendors, from whom they receive their product at a bill discounting feature. So, and the management gave the reason also because they know that they're going to grow, they need the products, and they want to be known as the best paymasters. And obviously, any vendors who is supplying to a company which pays them in advance, and take cares of their request, they will definitely prioritize them. And they believe that because of what they are doing and taking care of their vendors, they will get the first priority. At the same time, because they are paying in advance, they get a bill discounting feature. At the same time, the vendors are also happy and their working capital requirement is also gets better. The other question came on whether to look at the standalone numbers or the consolidated numbers. So if you have ever, reviewed the results of companies, so generally they have a standalone number and consolidated numbers. And most of the time we look at the consolidated numbers because that's where the overall picture comes from. But in right now, the management clearly said that going forward, we should look at only at the standalone numbers and not in consolidated numbers. The reason is why because the subsidiary which they had, which under which they had three manufacturing plants, They have closed it and they are liquidating all the inventory which is there. And once that whole process is completed, that entity will merge into the into V2 retail, and they'll have only one standalone number going forward. And the question was asked on competition, and especially the competition from Meesho, because we all know about Meesho. Meesho is an online retailer which sells product and everything. So over there, the management clearly said that they are not worried about it, and they gave the reason also, because and I'll read for you because they nicely broke it down, right? So what they said, that online players, for the online players, the logistic cost alone cost them around 65 to 70 rupees in India. And if they go move goods from one state to another state, and the acquisition of customer and the head cost, so it almost comes up to 50 to 60% of the total cost. So if they're selling a t-shirt at 250 rupees, their cost which they are incurring to sell that 250 is almost around 50 to 60%. But in case of retailing, what VT retail does, for them the cost is around 18 to 90%. So, and that is the reason why they're able to sell these products at a much affordable rate and still get good margins. And they are very confident that the online cannot deliver the same, because the additional cost that they have to incur into it. And the other thing that what management said is, they're going to start an omni channel in future, where they're going to sell their products online, and they will have the inventories in these dark houses. And what they will do is, right, whenever the orders come, they will the delivery will happen in the stores only, which is within a small radius. So automatically, the cost of the logistics comes down, and they will be able to sustain their low average selling price which they have right now. And the other question came on quick commerce. So they asked, okay, because of this quick commerce, are you seeing any impact on your overall growth? They said the numbers of apparel that they sell are quite less of the overall volume. And one thing they said that we need to understand is, people, that buying clothes is still an experience, especially in small towns. They want to go to the stores, they want to touch the product, they want to feel the fabric, they want to wear it and see how does it look. So they clearly said they don't think there'll be any much impact on on their sales at all. So they asked how are they retaining their customers, because the repeat customer number is around 68% that V2 retail gets. So the analyst asked whether they have any loyalty program and everything. The answer from the management was quite unique. You know what they said? That their gross margin, their assortment, and their products are their loyalty program. And the reason they said that is because they operate on such thin margins that, first of all, it is not feasible for them to run a loyalty program, but they believe that they want to sell the product at the right price. And the customers know that they get the best value from V2 retailing when they buy these products. So that's why they are coming back and back again. So there is no, so that's why they are getting such loyal customers, and the repeat customer numbers are so high. And for the demand, the management clearly said that they foresee to see that the same store sales growth for the next year will continue to around 8 to 10%, and they will add around 150 new stores. And the average size of these stores are around 10,000 to 11,000 square foot. And the other thing that they said, in the past 2 years, they have seen that the women's wear category has been growing one of the fastest. And they talked about the new states which they are entering. So they had entered 7 new states this year. So, and what they are doing, even though they're entering, they're seeing how things perform, and accordingly how well it performed, they're going to expand more. So what they said is 60 to 70% of their new store will come, where they're currently present, where they will open new store, and where V2 is already performing well. And the rest, 30 to 40% of the stores, will come in new geographies, which are already performing well at this point of time. So they gave example of Karnataka and Karnataka and West Bengal, where they are performing well, and they plan to open new stores over there. So in terms of capex, management said that the total capex that they require for every store is around 2.4 to 2.5 crores. 1.1 crore goes into investment in the store, and the remaining around 1.3 goes into the inventory. So another question came on that V2 retail has less gross margin compared to the other retailers in the same category. So the management clearly said that their concentration is not to increase gross margin, but their concentration to is in increase the EBITDA margin. And and the reason they said that is because in that way they can sell their product at at the rate which they are selling right now. And the way they will be able to increase the EBITDA margin is by increasing the sales per square feet. So the more they are able to sell within the same square feet, they're able to, even though their gross margin is low, their EBITDA margin will definitely increase, and they will get much higher operating leverage. And what they have said is that all the stores that they have opened last years have already started contributing to the EBITDA margins. So, they do not have to worry about it because they're doing extremely well. So normally their mature stores have a, how to say, per square feet sales of around 1200 rupees. The new ones which have already opened and crossed more than few months, they have already contributing around 720 to 730 rupees per square feet. And the another good thing what management said, which will contribute to their operating leverage, the overall employee cost has come down. It's not because they have fired the employees or they have reduced the number of employees, because the number of people remain the same, but they are servicing more and more more and more stores in terms of the head office, and due to which they're getting the operating leverage. And when we see the income statement, the employee cost has come down, and they said that it will continue to get this expand, and as they expand to new and new stores. So overall, if we see, they're doing quite well. They're growing their sales at around close to 50%. They are so confident that they're planning to open close to 150 new stores in the coming year. So all we have to do is just track the story and see how well it progresses, because they have been doing quite well for the past few years. And with the way the management is speaking and the tone that they are very confident that they will even do better in the coming years. So we will keep a track and I'll keep you posted. That's all for now. If you like this video, please do subscribe to my channel. Thank you and God bless.